You're listening to Questioning Your Sense, where you get real-world, pragmatic tax and financial advice for business owners, entrepreneurs, and independent contractors. Here are your hosts, Kevin Molen and Charles Steinmetz.
Hey folks, welcome to Questioning Your Sense. I'm your host, Kevin Molen, and as always, our ever-present and handsome co-host, Charles Steinmetz. Charlie, welcome. How are you doing today?
Good morning. I'm all right. All right. How are you doing today?
Not too bad. So let's go ahead and jump in, but let's do our usual segue. Is there anything in particular you want to tell me about today?
I was actually trying to think hard of something that would be monumental to share, and I just couldn't come up with one, so I'm going to rely on a movie quote, and it was one of my favorite movies. I'm not going to name it, but it was Enjoy the Little Things. So I think it's important. I remembered it. So
a rule of life.
Enjoy the little things.
If I ever heard one.
How about you? Anything monumental for me today? You share with me?
No. I've been doing a lot of studying recently. I'm sitting for my second part of my enrolled agents exam, and so that's been interesting. A lot of what we do is tax preparation. It's rooted in law,
right?
But this part of or at least a large part of this exam has to do with accounting, which a lot of people conflate tax preparation and accounting. The reality is I can't stand accounting, and that's living by these exact rules. And really, what we do is deliberately try and be flexible and manipulate the law based on someone's facts and circumstances to their best benefit. And so I don't like living in that black and white world, living in that box. I prefer living in the legal world where I get to
test world versus real world.
Yeah, exactly. But no, it's been good.
Excellent.
Okay, so today I think we're going to be covering an interesting topic, going over deadlines and some of the ramifications of deadlines in our lives in regards to the legal deadlines that the federal government has set in place for taxation purposes. And so, first, I guess it's worth just mentioning what deadlines are, right? So, inherent in the English language, we understand what deadlines are, but for the government side of things, when it comes to taxation, it's government compliance regarding taxation, and it has kind of mixed in their employment laws for purposes of withholding federal taxes for employees and submitting the necessary reports and that kind of stuff.
When we were looking at this, it was something that jumped to me, talking about what are deadlines, the government's perspective, and it struck me that there was actually a logical flow of just, it makes sense. In the end, we're all going to file an individual tax return, right? You have some earnings, you're going to file a tax return. There are things that have to happen so that you even can file a tax return in the first place. And so in talking about deadlines, there, again, my perspective, a flow of those. And so why don't we kind of just jump into when those deadlines jump in. So one of the first ones would be just date-wise then is there's your fourth estimated payments. It happens in January. It's the first one, so we're going to give an acknowledged nod for that. I think I'll mention quarter things later, but that was the first one. And then the end of the month, you've got some, as you're mentioning, the payroll taxes, right? So companies who pay payroll, they have to do a yearly thing at the end of
filing the 940.
Correct. Here's all the payroll stuff that we had done for the year, a summary that gets sent in. So then, and closely tied to that is filing of those W-2s and 1099s, the yearly amount of all the employees' wages. Again, logical flow. I can't file my tax return if I don't get my W-2 beforehand. And so to get those W-2s and 1099s kind of sent to you at the end of January, they're supposed to come, those employment taxes have to be filed at the same time, or just before that as well. And so as far as, again, logical flow in that. And then we've got things like financials. So financial institutions, people who have investments, stocks, dividends, et cetera, those institutions, I don't know how they did it, but they managed to chronicle enough. They get a little bit more time in those W-2s.
So let me speak to that for a moment, right? Because in 2011 is when the law changed in regards to reporting. Right. So actually prior to 2011, the individual stocks that were sold when a stock is sold, that's the taxable event. So a lot of people misunderstand the stock market in regards to taxation, because if I purchase 1,000 shares of Apple stock, it's going to run me a pretty penny right about now. But if I buy 1,000 shares of Apple stock and that stock rises over the lifetime that I own it,
hey, I made money.
Yeah, I'm not taxed on the valuation of the stock as it increases. The taxable event is upon the sale of the stock, and so just by holding the stock, there's not a taxable, but by selling it, there is. So what happens is you get to capture what you paid for the stock when you sell it as what's called basis, right? So if I buy, a share of Apple stock for $100 now and it sells for $200 tomorrow, I have a $100 gain, right? I don't pay taxes on the whole $200 that I sell it for. But prior to 2011, the person who was required to track the basis for each individual stock was the taxpayer, which is crazy. The sale of stock used to be the biggest headache in my job, but now, since 2011, the law changed. The burden of tracking basis, by and large, transferred to the clearinghouses, right, to the holding companies, and so. Along with that, though, came the difficulty of them getting all of their records in place and knowing the basis of all of these transactions by January the 31st. And so essentially the federal government says, okay, if we're going to give you all this extra work, right, that they're going to have to track now, then we're going to increase the amount of time that you have in order to get this paperwork out. And so it bumps that deadline from January 31st to February the 15th. Now, where it starts to get tricky is these companies have begun sending what they call preliminary statements, where they send a statement and with the statement, the phrase basically that this is not the final information. So they send that by February the 15th. But then by March the 30th, they send a corrected document with some really dramatic differences.
So here's the right number. Here's the updates.
Yeah. And so what happens is some people file their tax returns with the 215 document, right? The February 15th document. And then they end up getting this one. It becomes a huge issue, and there might be some penalties in regards to some of those errors and all of that. So yeah.
Lower income, not often, but could be a higher income.
Yeah.
That's what those end up being sometimes. So, and then do you want to jump in from there as far as the next piece? I think it was just where we are logically. I like the logical flow. But as far as deadlines, so we were through in the March.
Yep. So after kind of that next deadline of 215, the very next one after that is on 315. So this one is specifically in regards to entity type returns. So S corporations and I guess businesses who are required to file by 315. And this matters a lot because behind a pass-through entity like an S corporation or a partnership stands an owner or several owners who have to pay the taxes on the profits of these pass-through entities, because the profits are passed through, right? That's why they're called pass-through entities. And so in order, again, logically, like you're talking about, right? We're following that logic of when these things have to occur. The business returns have to be filed by 315 in order for the individual business owners to file their personal tax returns, which is the next deadline, which is 415. So we've got 315 and then 415, and then that pattern continues in regards to business and corporate deadlines over it being just about a month sooner than the individual deadlines. After the business deadline of 315, there's actually kind of a 4-1 deadline, which is having to have your IRA contributions in before April the 15th. You've got to have any IRA contributions you want to make for the previous year have to be in. And then on 415 is the April 15th deadline. Obviously, now we start hitting that first deadline that absolutely everybody knows.
Sure.
But there's been a lot of deadlines up until that point to get us to 415, which allows everybody to file.
Yeah. But the 415 also carries other deadlines, as you were mentioning. So we've got the individual tax return. It's your first estimated payment for that year. There's another thing called a FinCEN report. FinCEN is for those who have foreign financial accounts. You have to at least declare them. You're not necessarily taxed on it. It's just a, hey, where's your money overseas? They don't care. I have $1 million in the Caymans. I wish. But if next year there's $5 million in the Caymans, my FinCEN better show a $4 million increase and the reasons for it, or my tax return should.
Yeah.
Because if not, then I'm hiding money and I'm a bad person and they're going to come after me.
Yeah. So
that's all it really is just, hey, I have this money over here. I have the same money over here. I have the same money over here every year. And so that one's due at the same time. So it used to have a different date. Love the change. It's now just the same time with 415.
Yeah, and really, if you've got a small, foreign bank account that's got, $100 in it or something for traveling for purposes of, visiting family. I've got a bunch of clients who are from another country, maintain a bank account there, leave a little bit in there for purposes of traveling so they don't have to do the exchange and all that kind of stuff for their family members, have them as a signature on their account that live in a foreign country. It's just important to note that if you have less than $10,000, in the account, generally you're not required to report any information in regards to a foreign account. So the reality is this doesn't affect too many people, but there are a very specific subset of people who this impacts.
Absolutely. And then following, we've got the franchise reports.
Yep. On 515.
We have a logical reason why, but hey, I'll take it. It's just we have extra time to file the state franchise reports.
Yeah, the reality is a dramatic amount of the state franchise reports that are filed are no tax due reports, which means they are informational. And so, but yeah, they have a little bit of an extended time in order to get that through.
Gotcha. And then the last deadline we were going to plan to cover was just it's just the end of the year, more like a one-time deadline, end of the year of these RMDs. And so RMD is a required minimum distribution for those who have hit a magic age for your pre-tax accounts, 401s, IRAs. You're obligated to withdraw at least a portion of that. It changes every single year, goes up a little bit. If you're already drawing on your retirement to live, it's not an extra distribution. It's just you have to do it. And so those are those kind of one-time deadlines throughout the year.
Yeah, there are just a couple more, though, that we need to cover. At the extension deadline for the corporate returns is on 9/15, and the extension deadline for individual returns is on 10/15. So the extensions that you may secure for yourself are 6-month extensions, and so it gives you a longer time to file. Also worth mentioning, we talked about 1040 ES, kind of estimated payments. There are several quarters within the year. Several. There are exactly 4 quarters within the year. So why do we call them quarters?
We'll maintain the logical portion of this.
Yep. And so, the idea of these quarters is that you pay estimated tax payments if you're going to owe at the end of the year, and this is your chosen method for paying this ahead of time. Basically, the federal government says, you need to be paying the money that you owe on an accreted basis, right? So over time, not just file your tax return and then pay everything that you owe. It really does need to accrete over time.
Enough, like more than $1,000 or so.
Yeah.
$15,000 every single year. They really want you to pay them during a year. So
yeah, but we talk about quarters. There are several different types, right?
There are, and so sometimes it's a confusion that will often happen is someone will just mention, "Oh, I need to do my quarterlies," and I've been burned by thinking one when they meant the other, and so federal estimated tax quarters are the common one to consider, but there are other quarterlies out there, such as payroll taxes. Depends on the size of your company. Walmart doesn't get to pay theirs quarterly, but generally speaking, those payroll, the Social Security, Medicare, the things that your employer takes out of your check has to get remitted quarterly on a piece of paper and the actual money. And then for those that live in states like us, we have sales tax. And so that sales tax, if you're in business for yourself or run a small organization, that sales tax also has to get remitted to your state on a quarterly basis. So it's all the same quarters, the same dates, but there are different types of quarterlies that end up happening that could affect a single person doing all three.
Yeah, and for example, the estimated payment quarters are actually slightly different, right? So we've got quarter one is 4/15, quarter two is 6/15, right? So 4/15, April quarterly, generally 12 months. Quarterly is 3 months. April is the fourth month of the year, right? So it's not based on the fiscal quarters, right? So the reason it's April 15th, obviously, is you have filed your personal return at this point, and you should have some kind of idea if you're doing any kind of decent tax planning at all, which of course our opinion is you should. Then you may know to what extent and whether you do or don't need to make 1040ES estimated tax payments. So 4/15 then 6/15, just 2 short months later, is the next quarter, because April 15th is a longer quarter. The second quarter is a shorter quarter. Then it's 9/15. Yes, it's 9/15, right? And then it's 1/15.
That's
yeah,
a long quarter.
That tripped me up for a second. Yeah, because it's such a long quarter. Yeah, exactly.
3, and 4. All right.
Yeah, and so the fourth quarter is actually into the following tax year.
Right.
So these are not based on fiscal quarters, right? But then you've got your 941s, right? Your federal unemployment tax reports and that kind of stuff that are all fiscal quarters, right? And your state sales tax and that kind of stuff that are based on the fiscal quarters, right? So 331 and going every single quarter, over the course of the year. So definitely different types of quarters. Got to make sure you know what you're talking about in that regard.
Yeah.
Okay, and then looking at kind of these deadlines, these individual deadlines, they're a deadline because they have consequences, right? So the consequences of missing these deadlines range from I really barely care at all to this could be my largest expense over the course of the entire year, right? That the spectrum is quite wide. It also varies depending on your tax liability, right? So let's go into some of the consequences. Most of the penalties are actually quite small. So for example, if you don't pay your estimated quarterly taxes, if you ought to have and you don't, you may be subject to a small underpayment penalty.
Right.
Can you tell me a little bit about that?
So again, what I was kind of sidelining it earlier was, let's say you owe like $15,000 a year every single year. You're self-employed. The expectation is that you make your tax payments during the year versus all at once. By owing, let's say you do those 3 years in a row, it's an easy example on that. They'll hit you with this underpayment penalty. Essentially, that $15,000 parsed over those 4 quarters, you should have made these payments. It ends up being close to 2%. It's not consequently a big dollar number, but everything is relative, right?
Yeah, of course.
So the dollar number is small on that. So on this, when we're saying that these penalties are small, one of the ones I look at when I'm advising around paying these quarterly payments is for those that have to, especially self-employed people who run business for themselves, is talking about that, saying, hey, look, if all you can do is spend your brain power one thing or the other, and the one thing is keeping track of your expenses and the other is paying your quarterly payments, keeping track of your expenses is going to save you more tax than this little bitty penalty over here. Do this and be good at that. Then worry about, as you grow into it, doing this, estimated payments. If you want to rip the Band-Aid and do it all at once, sure, have at absolutely saving you some more. But this is what I would spend more of your time and energy doing, not fretting about how much to pay each quarter. That's a growth thing, not jump into it and do it.
Oh, goodness. I say be good at both. But maybe that'll take some time. Okay, so then so that one's relatively common. Another really, really common one is the late filing penalty. So for individuals and for C corporations, individuals and C corporations, the late filing penalty can be one of the biggest penalties that the IRS has, right? So in that regard, if you do not file an extension,
correct.
And even if you do in some cases, which we'll cover that, but if you don't file an extension,
you wait a year. Let's just say it doesn't matter at this point.
Well, we'll get into that though.
Okay.
But let's say you do not file an extension and you owe X dollars. Let's call it $1,000, right? and you don't file by April 15th. In fact, you filed by April 16th, and the deadline was on the 15th, right? So let's operate under that auspice for a moment. In that scenario, the penalty is 5% of the amount that you owe in that month in particular, right? So $50, not bad, right? But then let's say that you don't file until, May the 2nd. Now you're dipping into that second month, and now you're subject to another 5%. And it follows this trend of 5% per month of late filing up to a total of 5 months, which is a cap of 25%. Now, you owe $1,000. Not a big deal. $250, that stings, but,
manageable.
Yep, you can handle that. You owe $10,000. You owe $100,000, right? This penalty gets, it's still percentage based, but you owe $100,000. The penalty is $25,000, which is unreal
for just that one piece.
Yeah, absolutely. So that's not talking about interest and all that kind of stuff,
Correct.
Because clearly you're late filing, which means you're subject to interest on the amount that you owe. Now, it's important to note that if you file an extension, your deadline is not April the 15th, right? For an individual, your deadline is 10/15, October the 15th. So what happens if you file on October the 16th, if the deadline's the 15th?
Well, then logically, I should go 5% a month after that as well, correct? Wrong, Trebek.
Whatever. I don't think Trebek is the one answering the questions, Charlie.
Oh.
Trebek's the one telling them that it's wrong.
I would like to do it that way anyway. But so what happens at that point is the penalty is in full force at that point. It's like the extension. Once the extension deadline has passed, this is maybe one of those misnomers. Once the extension deadline is over, it's treated like the extension never happened in the first place.
Yeah, it's retroed back to April the 15th. And now you're way over the 5 months.
Correct. And so you get hit with a full 25%.
Yeah, full 25%. You would not believe the amount of phone calls that we make on those last couple of weeks of the deadline, of the extension deadline, trying to tell people, look, you've got to get me your missing information, or you've got to come in. We've got to get this filed. You need to just sign the paperwork. Sometimes it's as simple as sign the paperwork and get it to us, because, we can actually put a dollar figure to it, right? Because if they owe $10,000, we tell them, look, this is going to cost you $2,500 if you sign this tomorrow instead of today.
Right.
For example, when you get that close to the deadline, it gets pretty intense.
Life happens, and I understand that. And I'll tell people, look, I understand that life happens. However, it better be a $2,500 life penalty.
Yeah, exactly.
Or little Timmy the cousin can wait. And you can do this first.
So then that covers individuals and C corporations, right? And just for purposes of oversimplifying, C corporations are generally larger. The federal government has some requirements. If you have over $26 million of revenue, you must file as a C corporation. But for S corporations and partnerships, which are the kind of usually the smaller entities, not too small, right? $26 million of revenue a year is good business. But for our S corporation and partnerships, the penalty is a little different. In fact, these are pass-through entities, which means they are not taxed as an entity, which is really important because there isn't a late filing penalty in the same way, because they don't owe tax.
Well, charge me 1,000% of $0. It's great. Here you go.
But the idea here is that S corporations and partnerships must file on time, because if they do not file on time, then the individuals who are the owners or the shareholders can't file on time. And so let's say, for example, you have a primary shareholder of an S corporation who hasn't filed the S corporation yet, and they're the ones responsible as the primary shareholder, but they have 10 smaller shareholders that are waiting to file their tax return, and they can't because the primary shareholder hasn't filed yet. So there has to be a financial incentive, if you will, to get these to file on time. And the incentive is pretty clear. It's $195 per month as a penalty per shareholder or partner. So that gets pretty costly, right? At 10 partners, that's $1,950 a month. multiplied over, a series of months, that gets pretty intense. I mean, I see pretty commonly $1,500 to $3,000 of partnership and S corporation penalties for people who have just filed late,
Right.
Which is something that's easily avoided by filing an extension and being able to file timely to an extent.
Right.
And so those are a couple of the really larger penalties. It's worth mentioning kind of one more that can get pretty insane. In fact, I'll actually lump a second one in here, or maybe a fourth if we're.
I might have one throw in there too. We're not done.
Okay, all right.
Trying to wrap it up.
Surprise. But the required minimum distributions.
Mm-hmm.
So we'll probably cover this subject more in depth in the future. But let me just say, to oversimplify it a little bit, this has to do with you saving money pre-tax across your lifetime. And the federal government saying, we will let you pre-tax this money, but not forever. Eventually, Uncle Sam wants their piece of the pie, right?
Mm-hmm.
And so they're going to say, at a certain age, which right now that age is 72,
Mm-hmm.
once you hit that age, you now have requirements to distribute some of this pre-tax money so that the federal government, so that the federal government can tax it. To oversimplify it, this is around 3 to 5% of the amount that you have in these pre-tax accounts that ramps up the older that you get. So that's the oversimplification. It's more complicated than that. But the penalty for not distributing this money is 50%, 50, yep, 50% of the amount you should have distributed. So if you were required to distribute $30,000, which is a pretty common number, right? Somewhere between $5,000 to about $90,000 is the range in which I see. I very rarely, I don't think I've ever seen an RMD over $90,000. Now, certainly that could exist, right? But we don't cater to the hyper wealthy class. And so, anyways, yeah, exactly. But this RMD, this required minimum distribution, is pretty insane, right? Because even if you just have to take out $5,000, it's a $2,500 penalty for not taking out the $5,000. Right. It's 50%, no matter how you slice it. That's incredibly high. Yeah. So now what I'm going to do is I'm going to guess that the next one that you're talking about, because if you're not going to talk about it, then I am, is the...
which one?
It starts with an F and ends with an N. The Vincent penalty.
Yeah, what I was talking about earlier.
Yeah, hit me.
So again, it's not going to affect a large amount of folks. I say these penalties are on the FinCEN side of things can be extraordinarily high. So the joke is talking with people. It's like, if you have any, bank accounts overseas, Cayman Islands. Oh yeah, no, but we're not talking about that one. I understand the joke, absolutely. However, in seriousness, I need you to really answer me. So let's say you do actually have. I met with a couple and they were, in a position, they wanted to buy a house in Italy. No problem. They had to transfer they had to go through some hoops to get it there. They had to go through the EU first and then Italy. So they had to transfer money to the Great Britain, as it were, and then they had to transfer it over to Italy. And so at one point they had, because all that FinCEN cares about is the max value of the account was during the year at any point. It's not a put all the money and take it out. It's December 31st. It's only $10. I don't have to do anything. No, it's what was the spike. And so with that, the penalty for not declaring it, our jokes of but we're not talking about this thing. The paperwork involved, depending on how high it is, there's at least one set of FinCEN. Maybe there's something that goes to the tax return. It can go up to $10,000 a form. And if it's bad enough that the powers that be investigating go into it, they can seize up to half of the account value per year of infraction. So those penalties, I don't care if you're 17 years old. I don't want them for you to just hide your money for 4 years. The bad guys, the good guys, come in and take all your money and say, hey, now we're friends again.
Yeah.
Sure, we're friends. No. So it's just tell them where the money is here. Here's all you're doing is declaring that you've claimed all of your worldwide income. That's all that it is.
The other piece of this that maybe many people don't understand is that most countries at this point have a tax treaty with the United States.
Correct.
So there's a few that don't, right? Cuba and Russia, North Korea.
Oh, yeah.
They're probably not going to have tax treaties with the United States anytime soon. But, when we start talking about the EU, Great Britain, you're not hiding money if you've got money in a Great Britain account. The IRS will find that account. And obviously the Cayman Islands, they don't have a tax treaty with the United States. That probably will never happen. Who knows? But the financial independence there is pretty strong. And so it's not that you can't hide money from the federal government. It's that the risk of doing so is really tremendous. And I certainly am not rolling those dice.
Right.
Okay. So I think that covers our kind of consequences that we want to talk about. There's a lot of other penalties, right? When we start talking about businesses like Walmart, I mean, Charlie just mentioned Walmart,
Sure.
And that they don't get to pay their payroll. They don't get to remit those payroll taxes quarterly. They actually have to do it daily. And this is based on a valuation of the payroll taxes that you actually have to pay. Some businesses, can do it in longer periods of time. Some have to do it in shorter periods of time. Walmart, being the largest employer in the world, they have to do it every single day. They have to remit these federal taxes because it's not Walmart's money. It's their employees' money that Walmart is paying, and sending to the federal government themselves. And so you got to be really respectful and careful with that money. There are tremendous penalties, and the federal government can revoke your right to do business in the United States and all that kind of stuff. There's a lot of negative outcomes of you not filing those correctly. So there's a lot of stuff we didn't cover, but hopefully that gives you just an idea of the different penalties and kind of when they apply, how they apply, and what it's going to end up costing you.
So for those that are in business, self-employed, paying employees, there's a lot of different things to be wary of. I think many of those maybe tuning in on the individual side of things. I have a speech to sometimes give around the deadline time period, right? So when you consider penalties that are percentage based, we made the joke earlier, charge me 1,000% of $0. I don't care, it's $0. So if you were due a refund on your individual income tax return, right? Remember that penalty is 5% a month for not filing on time. But if you do a refund, how much do you owe the government? $0. And so during that time frame, if you, at least on a preliminary, and you're really confident that you are due a refund, the same speech of when I may call folks and say, hey, this little Timmy better be more than a $2,500 emergency. At the same time, you're due a $4,000 refund. Hey, look, if life comes up and little Timmy needs you, this can be super low priority. The deadline for claiming a refund is 3 years. You've got a lot of time to be able to claim that money back. And so there are plenty of occasions where a deadline, depending on your circumstance, doesn't matter to you. There is an arbitrary date that you need to do to keep you cognizant, to just put a check on the calendar that goes, hey, I should remember to do this by then. If you're due a refund, please don't delay. I mean, it's not worth waiting for them.
$1 in your pocket now is worth more than $1 in your pocket in the future.
Yeah.
The other piece to that, and what you're saying is 100% correct. And the other piece to that is, okay, for example, I was trying to figure out a way not to explain this entirely, but I will just go ahead and dive into it.
Explanation box, not soapbox, but explanation box.
Yeah, I'm definitely not soapboxing. This is not a soapbox. In fact, so far, no soapboxes. I think maybe we'll get by without one today, but we'll see.
It's hard for us to just talk about things, not explain them.
I know.
You may have never noticed this in a single podcast yet, but we're going to identify it right now.
This is our job. Get into the weeds and the details. So specifically in regards to, did you make me, you made me lose my train of thought, Charlie. You started going off. What were we talking about leading up to this? Tell me.
Deadlines, refund, having the money now, you can delay it.
Oh,
Doesn't
right.
matter
Yes,
as
I got
much.
it. Stop talking. I got it. So essentially, the federal government will recognize whether you are timely filed or not. Being timely filed is not irrelevant, right? Because what Charlie is saying is right.
Correct.
The deadline does not monetarily impact you if you are getting a refund, other than by filing it, you get your refund sooner, which does monetarily impact you, right? But it's important to note that if you have never had a problem with the IRS, right? Never, ever, ever. And something comes up, whoops, right now suddenly I'm subject to a penalty, and it was an accuracy penalty because I got something wrong on my tax return, and oh no, I now owe the IRS an extra $2,000 in penalties. There is a kind of a first-time forgiveness, if you will, a first-time offender, that you can request that the IRS abate penalties because you screwed up and it was your first time. The issue here is that one of the requirements of that is that you are, for lack of a better term, a faithful taxpayer, right?
Taxpayer.
You are filing your taxes on time and all that kind of stuff. And so while it's not a big, important piece, oftentimes what I advise my clients is, look, you really want to be considered a timely filer whenever possible. Like you said, if something comes up that's really important and they just were meaning to file, but they hadn't, and they're expecting a refund, it's not a big deal. But if you can, my recommendation is that you be on the books, be on Santa's nice list, right? Be on the IRS's nice list of, I am a timely filer.
Absolutely. So just one last, we'll move on to our last one. I think we focus a lot on tax returns that are other deadlines that IRS will impose on you. There's one that I deal with on a constant basis, which is folks who get IRS letters. I forgot something. I did take out $5,000 from my IRA and I didn't include a tax return because I assumed taxes were paid. That's a whole difference. We're talking soapbox on that.
We're not soapboxing that today.
No, we're not. But so something happens, you get an IRS letter. Either they make a mistake because it happens, or you make a mistake because it happens. And so it doesn't really happen from me, but it could happen from the clerical side of the tax return as well. And so there's something that needs to be addressed. Always on that letter, there is a date. You need to respond by this date, right? Commonly, those letters will say proposed amount due. We all read left to right. Everybody closes their left eye and just sees amount due. That's all they'll ever see. And that's fine. So that amount due is an amount. If you owe extra tax, they're going to charge you some interest and some penalty, and they give you a date. So that date, I'm trying to communicate this in a remove some stress method. That date is arbitrary in that the amount that it shows that is due is accurate through that date. If that date goes past, the amount due will just go up a little bit, another iteration of interest or penalty, correct?
Yeah.
Now, you wait that, it goes long enough through the chain of IRS letters, you just don't respond at all, it gets to a bad place. Sure, but that's many months. So if it's, again, you have an emergency, other things are going on, that penalty is generally a smaller set of things, letting one or two go by. Ignoring IRS letters for a year is a different scenario. We won't go deep into that, but I wanted to, as much as on the refund side of things, yes, file timely, as Kevin was saying, but the less stress when you do a refund of the deadline. Same thing with some of those other penalties that are small. We've identified it's one of the smaller penalties, and even IRS correspondence. There's a reduced stress thing that I would want to communicate on that. If it's not a hair on fire moment, you often have time. Most of the time, you can even call them if that's where you're going to go. Sorry.
No.
Most of them, you can even call them and say, can I get some extra time to work on this? And they go, sure, thanks for contacting us.
Yeah, I was just going to say, getting an IRS letter is a hair on fire moment for most people, right?
Correct.
And you're sitting here saying, hey, don't worry about it. Don't worry about the date. No, what Charlie's saying is 100% right. That date is just, this is the amount we're quoting you up until this date. And if you don't respond by this date, then the amount goes up. It's not a hard deadline like we're sending IRS agents with guns and handcuffs to your house to knock on your door if you don't respond by this date.
Because
now those letters exist, by the way, but they're very uncommon. So I'm actually gonna tell you guys something about Charlie. So Charlie and I have been best friends for almost 25 years at this point. And so
that's a big number.
I know, right?
I'm not proud of it, but
we're getting old, Charlie.
Oh,
so I'm going to tell you something about Charlie. Charlie, whenever you are talking to him and he thinks of something that he actually wants to say, but he doesn't want to forget it, Charlie crosses his fingers. While Charlie was talking, there was a point that I wanted to bring up, and so. What's that?
Did I miss it?
No, you didn't miss it. No, absolutely not. No, you're awesome and perfect and wonderful most of the time. But no, I'm talking specifically about just you, right? You're one of those types. So I always know when Charlie wants to say something because he crosses his finger.
You're respectful with them finish.
Yeah. But it's a visual indicator for me now. But no, just while you were talking.
You cross. I was like, oh dang.
Yeah. One of the things that I was thinking about was you mentioned the IRS. Sometimes it's the IRS's mistake. It's worth mentioning that there was a study done in 2011 that of the IRS correspondence that is sent out, over 58% of it was sent in error of the IRS. So I tell my clients that if you receive an IRS letter, it a majority of the time, right, or more than half the time, it's on the IRS's side. They've made a mistake, not my client. So, anyways, you just mentioned it, and so I was like, cross my fingers so that I don't forget.
Another less stress moment. Absolutely.
Yeah,
absolutely. So I think what I had written, at least in our general notes, was just we kind of talked about extensions. Just to rehash them, because I have a piece I wanted to interject in that. So we have deadlines. The deadlines are you need to do this by this time, right? Certain deadlines, not every single one, have the ability to move, right? So if you feel that you can't have everything done already, or just life is too busy for you, you can't possibly get this done by April or March, whatever that is, you can request an extension. Now, the thing I'm going to say about extensions is an extension to file with the IRS is literally called an automatic extension.
That's the name.
That is the name of the extension. Because people will worry, well, I don't want them to flag me or anything like that. With IRS correspondence, whenever we send responses back to them, very commonly, they send a letter back saying, hey, we got it. We'll let you know what we think in 60 days. Right? We need some more time to evaluate this. I'm not going to get this back to you immediately. So the IRS is 100% fine with giving you some more time to get that through. There is, how was I trying to describe it? I had an analogy for it. I give people all the time, and right now I'm drawing a blank.
Well, let me pick it up for a moment. Yes. Maybe you'll remember. It's important to know that when you file an extension, it's an extension of time to file, not an extension of time to pay.
Yes.
This is where it trips up a bunch of people, because if let's say, I own a business and I am the sole owner of the business. It's an S corporation, so it's a pass-through entity, and the business tax return is real complicated. There's a lot of moving pieces this year, and I didn't have all my records together, and I'm not ready to file. So I file an extension for the S corporation and consequently my personal return. And then by the time I filed the S corporation and I actually know what's going on, I know my profit, there's a lot more profit passing through for my S corporation than I anticipated. And so my personal return looks far worse than I had thought it was going to look, because I have to show a lot more profit on my personal return. Profit is a good thing. It's not a bad thing. If I'm walking down the street and I tell someone, hey, I was more profitable this year than I was last year, they are instantly going to think that that is good and not bad. But when it comes to filing taxes, more profit means more tax, right? So while you are absolutely chasing more profit, it does mean that you have to pay more tax. And so in that scenario where I filed an extension for my business and for my personal return, now I file my personal return and it could be July or August. Suddenly I realize I've got a $10,000 tax bill that I was not anticipating. And I'm not going to be subject to the 5% penalty each month that I'm late, because I have filed an automatic extension. The federal government said, yep, you asked for one, we're giving it to you.
Yep.
No questions asked.
Yep.
But that extended my time to file, not my time to pay. And therefore, I owe interest to the federal government because I did not pay the $10,000 when I ought to have because I didn't know, right? And so that kind of gets complicated. Did that give you enough time to remember your analogy?
I did not remember my analogy,
Okay.
but I came up with a new one, which I think will work
that's
just fine. So on the automatic extension, as you were saying, just no questions asked. So we'll make up a new one on the fly. It's like going to a store that's handing out free samples. The free samples are the extensions. You just walk up and go, hey, can I get one? Yeah, sure. Here you go. This is literally how the IRS views an extension.
It's free,
it's
it's automatic.
And it's automatic, and they want to give it to you. It doesn't, there's no skin off their back. They're freely handing them out in the first place. You're not doing anything off of them.
I applaud the analogy, Charlie.
So I tried. The other one, so when we're talking about extensions, we have this, my bit that I wanted to add in was, so there are extensions that you can request for occasionally, and we have seen a couple of these recently. We're going through one kind of right now, but sometimes disaster strikes, economic, what's the weather one I want to think of?
The hurricane? We're talking about the
Sure.
hurricanes and the kind of. So we're in Houston, obviously.
What's
so we
the
have to deal with
word
some-
economic? There's like an overarching or just climate, whatever. Big disasters. So pandemic could happen, hurricane could happen. So when that kind of thing happens, it's a federally declared disaster. One of the response to the IRS has rules and parameters, a little book they have to abide by. But essentially, they'll publish stuff saying, "Hey, those of you had deadlines for this, we'll move that for these purposes." Right. So Hurricane Harvey wouldn't hit Houston. Those who had an extension already on the books, hurricane hit in September. People don't have papers to file by October, and so they gave them until January 31st to file instead of the October 15th deadline. So it was just a free, hey, that one moved. Those that do quarterlies or companies paying the payroll ones or during the pandemic. We're all familiar this year that what was uncommon with the changes was they changed the time to file and they changed the time to pay. That one was the uncommon one. Most of them it's just time to file. But there are special circumstances that can move a deadline. So if you're in an area subject to, wildfires or a hurricane or anything that's a federal disaster, hail on my roof may not be a federal disaster. But there are things that can give you a little more time when there are circumstances that are just, how does insurance call it, the act of God? Right?
Yeah.
So those kind of things might be able to give you some more time as well.
Yeah. So now looking at those deadlines, setting them aside, the deadline has, let's say you met the deadline or you exceeded the deadline and it's time to pay the piper, right? So now you've got to pay the IRS. What advice do you give your clients in regards to paying the IRS when we know the bill?
Oh. Well, advice, I have a phrase that I use all the time.
Yeah.
My phrase is they will bend over backwards. They will move mountains, heaven and earth to help you pay them. So your avenues, your choice of how to get the dollars from your ownership to them are numerous. There are a lot of different ways to do that. So some may be easier than others, but it depends on who you are, what's easier for you individually.
Yeah, you can mail them payments with a check or a money order, right? You can pay online, right, through EFTPS.gov. Now, setting up EFTPS.gov is actually kind of complicated because you've got to create an account and they have to actually mail you. I don't know if it's a password or what it is that they mail you. I haven't set up an EFTPS account myself, but they actually have to mail you something, which means you can't just set up an EFTPS account at the drop of a pin. You can pay the IRS, you can pay them with a credit card, though the fees are pretty extreme.
You can pay directly on their website. So the website will be different than the FTPS type of deal. So going on their website, they've revamped it a number of years ago, so it should be pretty streamlined. You just go there, there's a giant button on the top left that says pay, just hover over it, and they'll give you a few options there for that too. So
yeah.
They don't care how, or not how, who pays them. And so if you're staring at a big IRS bill, there is the option for paying over time you can do with the IRS. but they expect perfection, right? You have to meet that amount every single month. An alternative, I'm not saying that I would suggest to advise it or just say this is what you need to do, but an alternative for some to at least consider as an option is taking out a personal loan or a loan from a friend to get that paid in full, because a bank or a friend may be a little more lenient. Please don't abuse a friendship, but on the,
Oh, Charlie, by the way, I owe a little bit to the IRS. I wonder if you could spot me a couple of bucks to...
Bro, man,
No, I'm just kidding.
I got you.
No, I'm just kidding. There was another point there that I wanted to mention. When it comes to paying the IRS, if you're going to pay them over time through an installment agreement, which is kind of this plan that Charlie's talking about, they're actually going to charge you to set up the installment agreement. It can be up to like $164, I think, is the most expensive one. And if you mess up one payment, they will invalidate that installment agreement, and you have to set up a brand new one. The other issue is that the interest that the IRS charges does not appear awful at first, but it does not compound monthly. It does not compound annually. It compounds daily. And that matters a really tremendous amount if you let this go over a long enough period of time, right? You let this go for a year or two, and then interest will end up, or 3 or 4. It could exceed the amount that you end up owing, right? I mean, the interest can be really, really incredibly high over a long enough period of time, which is, why we always recommend do not delay in working with the IRS. Do not delay. Get it done. Get it off your plate.
So on that, then, that makes me think of I'm going to transition, you can't stop me now, into the installation side of things, because there's certain speeches that I get to folks as well. When you're doing an installment agreement, so the same thing, they expect perfection, right? An installment agreement, a payment plan, is not a loan. They do not set it up so that the first 4 years of payments, you are paying like all interest and no principal. It is literally the IRS, when they go to apply the interest, they do it blind. When I say blind, is they just simply go, how much do you owe us today? Now we add interest. That matters when setting up your installment agreement with the IRS. Often, I'll meet people who will say, I just want to pay like $500 to knock this out. You absolutely can do that. I come from a super conservative side of my mind frame, and I think disaster is bound to happen, right, in your financial circumstances, but you can afford to pay $500 a month now. 6 months from now, AC breaks down and the car breaks down in the same month. I can't possibly pay $500, but you signed up for it and you have to. So what I suggest is the IRS gives you like 6 years to pay on an amount that you have due. So sign up for the most minimum payment they'll allow you to do. That's all you're obligated to pay. Pay your $500 a month, because when they go to apply the interest or more,
whatever you can afford,
pay as much as you can per month to knock that down, because it's going to save you an interest. However, when Christmas shows up and you got to buy all kinds of gifts, you can't pay that exorbitant amount in that month. All you're obligated to do is that $140 or whatever you have, that's the minimum, and you can stay on track with that. Please pay the highest amount that you can, but that's what I give to folks. When you're in that circumstance of, I can't pay it now, I need to be able to stretch this out over time, that's just something that I give for consideration. Again, that's your agreement, you set it up how you want, but on that, again, it's not a loan, it's not front-loaded interest. Sign up for a minimum amount, pay higher amounts on that, but that would potentially save you from one of those just ups and downs that life throws at us anyway.
Yeah. The other thing that I mentioned is if the amount that you owe is manageable enough, but you still can't pay it all right now, don't set up an installment agreement. Just send them big amounts,
like 2 or 3
to cover it over the next couple of months. Yeah. So if you can knock it out in 3 payments over 3 months, just don't set up the installment agreement, because as long as you keep sending them money, they actually aren't going to take collective action in most cases, as long as you're sending them a large portion of what you owe. So if you owe $4,000, right? If you owe $4,000 and you can send them $1,000 payments every month for the next 4 months, you may get a letter, but they're not actually going to levy your wages and take corrective action if you're sending them large enough payments. And so it keeps you from having to pay to set up the installment agreement, that kind of stuff. You just have to know, I'm probably going to get a letter from the IRS. And don't freak out. Don't have a heart attack. Don't have heart palpitations, right? If you have an issue, call us. But I think that covers it mostly as far as what we wanted to talk about in regards to the deadlines. Hopefully you have a better idea now of what deadlines you are subject to, but beyond that, also maybe what deadlines your employer is subject to and why it takes so long to get your W-2 or whatever documents that you need to get and all that kind of stuff. And then also kind of penalty amounts, what the consequences of missing these deadlines are, and how to pay the IRS if you owe them. So now that content is covered, Clark, I think we'd like to go into comfort zone. We may have time for 1 or 2 questions today. Taster's choice. What do you got for us?
I have one question for you today. I am divorced. When can I claim my children as dependents?
It had to be that question. It's never an easy question, is it, Charlie?
No.
It never will be.
Well, that's good. So I'll start.
Sure.
Facts and circumstances, guys. It's going to depend on what's actually happening. So may I ask some context, Clark? Is this person divorced in that year, or this is years later we're talking about this?
Let's say both.
Okay.
One of each. They were divorced this year and
in that year, situation. Right? So one of the ones that is easy to trip up with tax preparation is that we deal with federal law. And federal law does trump state law, technically, right? However, it's not going to stop someone taking you back to state court and hitting you with breaking contract or whatever the term is.
Well, why don't, instead of getting into that, why don't we dive into just what the federal, what the answer is,
yes.
Right?
With whom do the children live more than half of the year?
Yeah, it boils down to that. It's as simple as that. The reason why Charlie asked the qualifying question there is hugely relevant, hugely important, because if you were divorced in October, for example, but you were living together all the way up until that point, then the child lived with both of you
for more than half the year.
Yep, exactly. So it complicates the answer, right? The answer is almost never simple. In regards to federal law, the question really boils down to who did the child live with more than half the year? It even goes down to nights, right? So the tax law boils it down to who did they live with for more than 50% of the nights of the year. 365 days a year, not counting leap years. You can't have them both for 50% of the year. So it's going to be more than 50% of the year for one of the parents. That parent becomes the custodial parent. That is not to be conflated with custody, having custody of the child. Custodial, it does not mean custody in the same way, right? So the federal tax term is custodial parent. The custodial parent is the one who has the right to claim the child. Now, a lot of people like to trade dependents on tax returns. Right. Like their horse blankets, and that's not the way it works, right? We can't just trade dependents on a tax return. But the custodial parent can file a form or provide to the non-custodial parent a form to waive their claim and allow that non-custodial parent to claim the child.
So a child lives with me. They go to the school district in my homestead. Medical records are tied to my principal residence. I'm the custodial parent. My ex-spouse, in our divorce decree, I must, and I choose to, but technically should be the same thing, but they end up being separate things. To do that right, I would then fill out that form and say, I'm allowing this person to claim my dependents.
That's a form 8332, right? That is filled out, and you can revoke that filing anytime you want as the custodial parent. But that gives you the right, basically, or gives the non-custodial parent the right to claim the child, which means for two natural parents, you can trade, if you will, for lack of a better word, dependents. But generally speaking, only one parent can qualify in most cases. There are some fringe cases where more than one person can qualify, but usually only one person can qualify, and that person would be expected to claim the child. The sad reality, Clark, is what often happens is the first person to file to put the child on their tax return, that person is now in the electronic system with the federal government. And so if that person is not the custodial parent, and then the custodial parent comes behind and tries to file and tries to electronically file, then the federal government says, no, that dependent's already been claimed. You can't file an electronic tax return with that dependent. So
it's
then,
a smart system, it's an intelligent system. You can file a Social Security.
That's smart. It's not intelligent.
It doesn't know.
Oh, I love that, Charlie. I haven't heard you say that one before. And so in that regard, then we have to advise, well, either you want to file a paper tax return and force the issue and tell the IRS, yeah, absolutely. But if this is a $500 credit or a $2,000 credit, how much do you want to stir up with the IRS to be able to claim this dependent? Because it may not be worth the headache. And that's where it really starts to get annoying, is if one spouse who is not the custodial parent files this tax return and the child is 17 or 18 or 19 years old, so they don't get the higher $2,000 credit for being under the age of 17. Instead, they only get the $500 dependent credit. That starts to get really annoying, because is it worth $500? Probably not. But you really have the right to claim the child. But it's probably not worth the heartache of getting the IRS letters and having to show proof and all that kind of stuff. And so this is kind of a hot topic, and this kind of stuff happens all the time. We start talking about non-compliance. There are people who just, maybe they don't work and they get child support for this child and government welfare. And so they don't actually have to file a tax return. And so they just let their friend or their cousin or their brother claim their couple of kids. I mean, the non-compliance in this area is wild. I mean, it's really wild.
That the rules they've added because of that.
Yeah, the gross mishandling of claiming dependents truly is unreal. I mean, people just don't understand the rules in regards to claiming dependents. They just know that if the dependent is only claimed once, it won't be questioned, right? And so if I let my buddy claim my child and I don't, then the IRS isn't going to question it because nobody else tried to claim the child. So it's almost never going to become an issue. Right. And so it's just turned into this really non-compliant area.
So all good data. I'll try and circle back to the original question of the when can I claim it, right? So federally, it's going to be, does a child live with you, go to your school, you have all the medical records and paperwork to back it all up, you can claim the kid. Do follow the divorce decree. There are a lot of reasons you need to adhere to both federal and state. And so if you're the one who's the custodial parent, then you're the one who's going to claim the kid. If you're the one who is not going to be the custodial parent, and in the divorce, it stipulates that you're allowed to claim the child on your taxes every other year, insist that the verbiage is included in the divorce decree that they must provide you that form 8332. That way you've got some tangible proof to, if the other person then claims the child when they shouldn't, in the year they shouldn't, because of a flip-flop or whatever, then you've got someone to say, hey, here's IRS, why I'm able to claim this. You can always take them back to state court and have the issue solved there. But that ultimately is going to be, hey, you can, but if you're the other person, insist on this so that you have more clout in doing it the right way.
Yeah.
That answers it. Thank you.
Great.
Awesome. All right, folks. Well, thanks for joining us today. Thanks for Charlie providing your awesome insight and covering all the deadlines and the consequences of all of that. I think we had some nice, lively discussion. And so look forward to being able to give you guys some information again in the future. But for now, we're going to go ahead and sign off. This has been Questioning Your Sense with Kevin Molen and Charles Steinmetz.
Thanks for tuning in to this episode of Questioning Your Sense. If you haven't done so already, be sure to subscribe to this podcast, leave us a 5-star review, and don't forget to share it with a friend. If you would like to submit a question for our review on this podcast, feel free to email us at info@molentax.com.